Hi everyone, welcome back to Options Made Simple. In this video, we're going to be going over the Greeks that affect the value and pricing of your options. There are many Greeks out there, but the ones that we will be talking about today relate to the price of the underlying, volatility, and time passage. These are otherwise known as delta, gamma, vega, theta, and I also threw in charm at the end as well. Now, not to make the concept more complicated than it has to be, but it's important to understand that there are different orders, or levels if you will, for the Greeks. There are first, second, and third order Greeks that all affect the price of your option, but they do it in different ways. First order Greeks directly affect the price of your option. Delta, Vega, and Theta are all first order Greeks that tell you the theoretical gain or loss of value you can expect in the price of your option when either the price, volatility, or time changes for your option. A second order Greek tells you how sensitive your first order Greeks are to changes in the underlying volatility or time. In other words, your second order Greek determines how much your first order Greek change when things start moving. Gamma, Vana, Charm, and Voma are all examples of second order Greeks. And your third order Greeks measure the change of the second order Greeks. I'm just going to leave it at that since this video will not be going into third order Greeks. Alright, so we'll start with delta. Delta is defined as the change in an option price based on the change in the price of the underlying security. So to put that in English, your delta tells you how much money your option will gain or lose as the price of your underlying changes. The highest the delta can go is 1, and the lowest that it can go is 0. For example, if you have a call option with a delta of 0.35 and your underlying goes up $1, then your option will gain 0.35 cents worth of value, which is equivalent to $35. Or if your underlying goes down by $1, then your options will lose $35 worth of value. Puts have a negative delta because your option will lose value if the price of the underlying goes up. So if you have a put with a delta of negative 0.22, your option will lose 22 cents if your underlying goes up $1 or gain 22 cents if your option goes down by $1. Here's another way that you can look at delta. Since each contract represents 100 shares, if your delta is 0.20, that means that you're netting 20 cents a share every time your underlying goes up by $1. Or you can just look at it as having 20 shares that would make you $20 if the underlying went up by $1. When hedging with option contracts, you'll want to match up your delta to be equivalent with the amount of shares that you own. If you were long 58 shares and wanted to hedge your downside, then they should be hedged with an option that has a delta that is close to negative 58 or negative 0.58. This is known as delta hedging. One last thing I'll add about delta is that it is commonly used to measure the probability of an option expiring in the money. A 0.50 delta option is said to have a 50% chance of expiring in the money. For all you statistic nerds out there, take a note that 16 delta options are one standard deviation away from the mean. In order for that option to expire in the money, you would need a one standard deviation move from the current price. Your delta doesn't stay the same throughout the life of your options, it changes as the underlying changes. To find out what your rate of change would be for the delta, you have to examine the gamma of the option. Gamma is a second order derivative that measures the rate of change for the delta. Long options have positive gamma, while short options have negative gamma. Gamma is greatest for at-the-money options and decrease the further in the money or out the money you go. Short-dated options have a higher gamma than longer-dated options, which is why the price of short-dated options are more volatile and can gain or lose value faster than longer-dated options. We'll use AMC for an example. The gamma for a 13 call option expiring this Friday is 0.29, while the gamma for the 13 call option expiring in August is only 0.04. While the delta of these options are very similar, if AMC were to go up $1, the gamma tells me that the delta on the May contract will go up to 0.92, while the August contract would only increase to 0.72. If AMC were to go up another $1, your May contract would gain another $92 worth of value, while your August contract would have only gained $72 in value. Gamma is used by market makers to hedge the options they sell in the event of short squeezes or rallies so they're not left holding naked calls. They essentially turn their calls into covered calls by buying shares based off the gamma to hedge off their risk. When there's a frenzy of call option buying on a particular stock like GME, for example, the market makers wind up having to buy massive amounts of shares, which in turn pumps up the price of the underlying. This is known as a gamma squeeze and heavily played into the GME saga. Once those options expire though, market makers then sell off their shares that are left over from their hedge positions, which can create a massive sell-off after the short squeeze. For those of you who are curious or want to dive deeper into gamma, speed is the third-order derivative that measures the rate of change in gamma, although I won't be covering that in this video. Okay, so for all you volatility freaks, Vega is the first-order Greek that measures your option sensitivity to volatility. To explain further, spikes or drops in the volatility of your underlying will affect the price of your option. This added or subtracted value is completely separate from the delta of your option. Volatility is measured in percentage and not dollars, so if the volatility on your underlying raises by 1%, then the Vega will then tell you how much value your option will gain or lose. Vega is highest for at-the-money options and increases the further out you go in expiration. For example, Tesla is currently trading at about $580 per share, and at-the-money 580 call option expiring June 18th currently costs $38.20 and has a Vega of 0.69 and an IV of 61%, while the September 17th $580 call option is trading for $70.75, has a Vega value of 1.32 and an IV of 60%. Now, if the IV on your June call option were to go up from 61% to 65%, this would be a 4% increase in IV. Your call option would gain $2.64 in value, or in other words, increase by $264. Or if the IV of that option dropped from 61% to 51%, your option would theoretically lose $690 worth of value. As you can see, there's a lot of money that can be gained or lost by rapid swings in the volatility of an option. When trading high IV options, it is best to keep an eye on your Vega to evaluate your risk of IV crush and determine how much you stand to lose from a drop in volatility. VOMA is a second-order Greek that measures the rate of change in Vega and tends to be higher for further out-the-money options than for at-the-money options. Okay, now on to everyone's best friend or worst nightmare, Theta. In recent days, Theta has actually begun to label itself as a violent gang that focuses on selling and distribution through IV as if it were a drug. But that's besides the point. What's important here is that Theta measures an option sensitivity to time decay. All options, whether they're in the money or out the money, have a time value, sometimes also called extrinsic value. As time passes, this extra value decays. Theta is negative for call options and positive for put options because it is always measuring the amount of value your options is losing on a daily basis. Theta is greatest for at-the-money call options and decreases the further in or out the money you go. Longer dated options have smaller theta values than options that are close to expiration. The theta value will tell you how much value your option is losing on a daily basis, regardless of if it's in the money or out the money. If you're currently holding a call option that is trading for $4.28 and the theta on your option is 0.04, this means every day your option is losing 4 cents in value, or $4. After a week of trading, an option with a theta of 0.04 would have lost $20 worth of value. Keeping this in mind, sometimes it can be best to sell a non-volatile option before its expiration date if you don't plan on exercising the option due to the value you'll lose from theta. If you look at this theta time curve, you'll see that it's at the 30-day mark that your options really start losing theta at a more rapid pace. So in a sense, buying at-the-money options within 30 days of expiration is really poor value from a theta perspective, although it can provide you with lucrative gains if you're a seller of options. The last Greek I will discuss is charm. You likely won't be able to find this under your option chain, but I believe the Greek is important to be aware of and understand. Each day that passes adds or subtracts from your delta, moving it closer to either 1 or 0. Mind you, that delta may never actually reach 1 or 0, but the important concept here is that it is always in motion. Charm is the measurement of that rate of change in delta as time passes. In the money options have positive charm, it will move the delta closer to 1 as time passes, while out the money options have negative charm, it will move the delta closer to 0. Options that are at the money will usually hover around a delta of 50. This graph from optiontradingtips.com does a great job of providing a visual representation of charm and its effect on delta over time. Charm is especially useful for traders who like to delta hedge their position. Delta hedging often requires rebalancing of your delta at the end of the trading day or the trading week, so it can be important to know how much your delta will decay when rebalancing. Please keep in mind that there are other Greeks in play with options, and all of them affect the price of your option in one way or another, but if you have an understanding of the main Greeks in relation to the underlying price, volatility, and time, this will give you a much better understanding of your options and why they keep losing money. Feel free to post any questions or to call me an asshole in the comments. Till next time.